Hello everybody, my name is Lush Eisner and welcome to the Canadian Money Talk, the channel about Canadian investing and personal finance. Please like and subscribe. I record 2 videos per week, so make sure you ring the notification bell to get notified each time one comes out. This video is about the price to earnings or PE ratio, what it means, how to interpret it, and how it varies by sector. The Silicon Valley chipmaker Nvidia achieved something this year that only 5 other companies have done: claim a $1 trillion market cap. In May, Nvidia surged by 24% in a day and is now up nearly 200% on the year. The sort of bonkers rise usually reserved for penny stocks, which Nvidia, the maker of chips that power AI, is definitely not. But the wild ride has left investors divided. Some think Nvidia is grossly overpriced based on what it's known as the price to earnings or PE ratio, while optimists say the price is reasonable. So who's right? Well, it depends on what you think the PE ratio is telling you. Price versus value. Let's start with something every investor should understand: the PE ratio. It's a formula that helps you judge a stock's value, or even the value of an index like the S&P 500, by looking at a company's stock price in relation to its earnings or profits. You calculate it by dividing the price of a share of a stock by the company's earnings per share, or EPS, which you can find in its earnings reports. And the result helps you decide whether you're getting a good deal. Think of it like this: $50 is expensive for a bologna sandwich, but cheap for a fancy 3-course meal. Stocks are similar. If the PE is high, a stock is expensive for what you're getting, earnings. If it's low, it's perhaps a better bargain, though which is actually better depends on a company's growth, but we'll get to that. The PE can be thought of as how many dollars you are paying per dollar of company's profits right now, or how many years the company has to be in business to make enough profits to cover your investment. You are making the investment for the company to earn money to eventually pay you back, after all. The average PE ratio varies by sector. High growth tech companies tend to have higher PEs, since they presumably will grow into their valuation as they, theoretically, rake in more cash, while lower growth companies tend to have a lower PE. Value investors, such as me, tend to like PEs in the neighborhood of 10 or in the teens. Tech investors or overall growth investors are fine with 20 to 30 or more. Okay, so back to Nvidia. On Friday, July 7th, 2023, Nvidia stock price was $425 US, and its earnings per share is $1.92. So its PE ratio is 219. But to get a sense of Nvidia's value, you need to look at its PE ratio over time. In January, it was 60. Last summer, around 50. Moreover, 2 competitors, Intel and Taiwan Semiconductors, have PEs around 17. That means Nvidia is expensive compared to its past value and its competitors, right? Here's my best attempt at a M. Night Shyamalan twist. Maybe not, actually. The trick is about value. The PE ratio offers an imperfect picture of value. That's because, and this is crucial, when you buy a stock, you buy a claim to a company's future profits as well, which are not reflected in its current or trailing PE. This is why picking stocks is tough. You have to guess what the company's earnings will be, and no one knows the future. We can guess at the forward PE, of course. As a result, whether investors decide to buy a certain stock ultimately comes down to what they believe will happen in the months or years ahead. Nvidia, for instance, has said its revenue could grow by 50% from Q1 to Q2 of 2023, which analysts expect could lead to a 2.5 times increase in profits by the year's end. Even if Nvidia grows a more modest 20% to 30% after that, its PE multiple will look normal-ish at around 40 by the beginning of 2026. This would make the price investors pay today look pretty good. but Nvidia's growth could slow, which would mean today's investors overpaid. So what about stocks generally? Right now, PEs, both broadly in the S&P 500 and in tech, are below where they were in November 2021 before the stock downturn, yet they're higher than they've been historically. But the next M. Night twist is, well, we don't know yet. If you think the PEs are justified, it's probably because you think we're bound for an economic boom or you're bullish on AI. If you think PEs are too high, it's probably because you suspect a recession lies ahead or AI is overhyped. Such uncertainty is why many long-term investors regularly contribute to broad-based index funds rather than try to time the market by buying individual stocks. But whatever you decide to do, it's good to know what sort of deal you might be getting with the help of the PE ratio. It's one important, though not all revealing, piece of data in the narrative of a stock. If you have any requests on what you'd like me to cover in future videos, please put that in the comment section. If you'd like to get in touch, please reach out on any of these social media channels, and may you have a profitable day.